Throughout millennia, gold has always benchmarked a true value of all foreign exchange currencies as they came and went. And once they were meddled with, each and every single currency failed. And so, as is the case now, will fail again. So, cut a long story short, Nixon removing a fixed exchange price for gold did not halt the gold outflows, as global gold assets continue to be valued in real time, only at a much higher price against the dollar in the foreign exchange market. So nothing changed.
In the Live from the Vault episode, Andrew Maguire discusses the possibility of a black swan event triggering a revaluation of the gold price. He argues that the global financial system is increasingly fragile and that a significant event could easily tip it over into a crisis. If this were to happen, he believes that gold would be one of the few assets holding its value and that its price would likely rise sharply. Maguire believes that while other central banks openly accumulate physical gold, the Federal Reserve is trying to delay the revaluation. Russia, China, and some other countries have secretly purchased large amounts of gold, indicating their belief in its value. In contrast, the Fed attempts to maintain control using synthetic means rather than physical gold. The Fed faces challenges related to claims of double ownership of its gold reserves and the decreasing availability of paper gold. As the effectiveness of synthetic price manipulation within the COMEX exchange declines, Maguire sees an opportunity for a global reevaluation of gold prices based on physical gold. Now let's watch excerpts from Andrew Maguire. Be sure to watch the entire video and consider subscribing to our channel. Don't forget to enable post notifications to stay updated on our latest uploads. Thank you, and enjoy the video.
There's no doubt that a gold market revaluation is inevitable and imminent. And it's the Fed that's running out of the tools to keep what we call the synthetic cap on gold. And the same acts, of course, in silver, into an increasingly liquid global physical marketplace. Now, that was never envisaged when the COMEX was set up. Now, this week, and based upon direct, up-to-date, first-tier liquidity provider feedback, we'll take a look at how the Fed's sole remaining tool to cap gold, which is the COMEX Futures Exchange, is running out of sufficient liquidity to maintain the 50-year synthetic hedge against the Fed's massive borrowings of derivative gold, and how this has to be resolved by way of a capitulative third and final historic US dollar gold price revaluation. In the past, we went through how the other two were implemented. Now, this time, we're actually looking at a price revaluation from $42 an ounce. Now, the implications of this are enormous, and we need to be ready. The focus should be primarily about wealth preservation, and we're evidencing a very small window in which to take the action. And while every other global central bank has been openly accumulating physical gold, alongside very large allowable undocumented tonnage purchases of undisclosed monetized gold, which does not have to be listed, and that's been primarily Russia, China, and some of the BRICS Plus jurisdictions, it's clear by the divergent and increasingly globally arbitraged COMEX market footprints that the Fed is the sole remaining outlier. The lone central bank still attempting to contain and delay the inevitable gold price revaluation process. We can see that. You just have to look at this week's action, and you can see how they're still trying. However, what we do see, though, is the Fed faced with dealing with massive rehypothecation, i.e. double ownership claims, on the listed 8,133 tons of pledged treasury gold reserves that they look after. And, you know, they're now aware they're on the back foot. And as liquidity to maintain the paper gold illusion evaporates to unsustainable levels, the Fed is as disruptively as possible trying to exit these extremely large, wrong-footed, undeliverable derivative market long dollar bets which have been made against gold. And long dollar is a fiat currency against gold, which is a physical product, which they're largely aggregated in the non-Basel III compliant, US-centric, COMEX-centric, cash-settled gold futures markets. Note cash settled. Now, these synthetic derivative bets against gold have relied upon creating and upholding and maintaining a synthetic price manipulation structure contained inside the COMEX exchange. But their actions are actually catching up with against an increasingly liquid physical exchanges around the world. Telegraphing these efforts to contain gold by synthetic means are on a slippery slope and measurably failing. As this situation presents an opportunity, our focus is on exactly where we are in the competing, globally driven, physical gold driven revaluation process. Clearly, that is what we're trying to focus on.
Maguire explains that the gold exchangeability window has been reopened under Basel III compliance. This means that gold can once again be exchanged with other assets. To meet the compliance requirements, physical contracts that can be fully delivered are necessary, and these contracts must be supported by central banks worldwide. As a result, central banks are now obligated to maintain physical gold reserves as a backing for their agreements involving gold. However, this development has posed challenges for the Federal Reserve regarding its ability to manipulate the gold market. The Fed also faces increasing pressure from foreign banks wanting to revalue their gold holdings. These banks are using a new mechanism called the COMEX EFP conduit to force delivery of COMEX derivative gold prices. This means that the Fed could be forced to give up physical gold if it can't meet the repatriation requests from these banks. Let's get back to the interview.
And while the Fed denies intervening in the gold markets, they do openly admit actively cooperating with other friendly central banks to intervene in the foreign exchange markets. That's dollar gold, that's pound, euro, dollar, yen, exactly, and all of the other crosses. But that includes gold and silver. So with sleight of hand and an unlimited ability to print dollars by converting the physical gold market into just one more unbacked fiat currency, for the ensuing 50 years, they were able to surreptitiously manage the cash settled gold price. Note, while gold was able, it is to be cash settled. But on the first trading day of 2023, as we said at the time, Basel III NSFR compliance turned the 10 times larger spot gold foreign exchange market into a fully deliverable, physical deliverable contract, which had to be backed by physical. Global central banks realized this had reopened Nixon's dollar for gold exchangeability window, exposing the back door of the otherwise cash settled COMEX exchanged EFP mechanism. We talked about that before. That's just simply a mechanism in the COMEX where you can transfer an undeliverable cash settled contract into a deliverable contract. So it created this back door. And so we saw this unfactored physical outflows going into Basel III compliant, fully physically backed spot gold delivery markets. Now, the COMEX EFP backdoor is providing global central banks, friendly and unfriendly, that is, a window for competing central banks and sovereigns to capitalize and force delivery of the COMEX derivative gold price. That's a huge deal. That was not available before the 1st of January. Hence, under the smoke and mirrors leverage, the drain of lifeblood COMEX paper market liquidity began. And 6 months in, now, here where we are, into gold being revalued as a first-tier asset, gold has only just begun to be more widely noticed by Western traders, certainly being noticed by Eastern traders. If you need to revalue and you're a foreign bank and you have gold at the Fed, you're going to ask for it back before you do it, aren't you? So really that would happen. So that's not what the Fed wants to see. And tapping into the gold revaluation account facility is simply a matter of selling and immediately buying back the same amount of gold for a realized gain. This would happen without warning and likely be implemented over a weekend. And as we recently discussed, the Fed revaluing US dollar gold would be a preferable option than having to fail to deliver on any more central bank repatriation requests, which would expose the true extent of the 8,133 tons of treasury gold how deeply they're rehypothecated and have multiple ownership claims on them.
The current global financial system is increasingly fragile. If a black swan event were to occur, it could trigger a sharp increase in the price of gold. The price of gold will likely remain volatile in the near term, as the global economy is still recovering from the COVID-19 pandemic. However, in the long term, the price of gold is likely to increase as the global financial system becomes more fragile. Do you agree with Maguire's assessment of the gold market? Do you think a black swan event could trigger a revaluation of the gold price? Please share your comments and observations in the comments section below. Additionally, if you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.